All right, let's jump right in. You ever wonder why some random Tuesday afternoon on Wall Street can send Dollar Street into a complete tailspin the next morning? Well, today we're going to unpack exactly that. We're going to look at those invisible threads that connect the US and Indian markets so tightly. And really, it all boils down to this one big question that I'm sure every single Indian investor has thought about. Are our markets really in the driver's seat, or are we just, reacting to whatever happened in the US while we were all asleep?
I'm sure you've heard this narrative a million times, right? The whole India is a domestic consumption story thing. This idea, this decoupling dream, that our huge economy somehow shields us from all the chaos out there. Look, it's a really popular story, but it's just not the whole story, not by a long shot.
Okay, so to really get a handle on what's happening now, we've actually got to rewind the clock. We're going to look at what is basically a tale of two completely different eras, starting with a time when, believe it or not, these markets were pretty much separate worlds.
So check this out. Back in the 90s, after liberalization, the Indian and US markets might as well have been on different planets. There was almost zero connection. But then you get into the early 2000s and FIIs, that's foreign institutional investors, start coming in, and you can see the threads starting to form. Then, bam, the 2008 crisis hits, and that's when everything gets fused together. And today, the correlation can be as high as 0.89. That's basically moving in lockstep.
And this is the really critical takeaway, the part that so many people miss. A strategy that was a total no-brainer back in the day is just, well, it's broken now. I mean, in the 90s, if you held both US and Indian stocks, you were golden. It was a killer diversification strategy. But today, that safety net is gone, especially when things get ugly. When a real global shock hits, everything goes down together. The diversification benefit just evaporates.
So what on earth changed? How did we get here? Well, it all comes down to something we can think of as the global money pipeline. And to understand it, we've got to follow that pipeline right back to its source.
All right, the key concept here is something called global liquidity. Now, I know that sounds super jargony and complicated, but it's actually pretty simple. It's just about how easy it is to borrow US dollars anywhere on the planet. And since the dollar is the world's go-to currency, the US Federal Reserve is the one who's basically standing there with their hand on the global money tap.
And here's how that chain reaction plays out, step by step. It all starts in Washington. The Fed tweaks interest rates, right? Instantly, the cost of borrowing money changes for everyone, everywhere. That's the signal for these massive global investors, the FIIs, to start moving their money around, chasing the best and safest returns. So if US bonds suddenly look more attractive, guess what? They yank their cash out of emerging markets like India. And, just like that, a decision made halfway across the world makes our markets either soar or tank.
Okay, so now we get the why. We understand the source of the money flow. So let's talk about the how. How does this volatility actually travel and hit our markets at lightning speed?
So the first big channel is the FIIs themselves. You can think of it like this. Our domestic investors, they're like the bedrock, the stable foundation of our market. But the FIIs, they're the ones on the margin, making the huge, fast trades. Their hot money is what creates the waves, what actually sets the price and the direction on any given day. They have an absolutely outsized impact. And if you want to understand the sheer scale of this, just look at this number, $20 billion. That's how much money flowed out of India in a single financial year after the US Fed just hinted that it was going to raise interest rates. That right there is the power of that global money tap being turned just a little bit tighter. But what's really fascinating is that this isn't a two-way street. The impact is totally asymmetric. When FIIs unexpectedly start selling, it causes a massive spike in volatility. It's all about herd mentality, right? A global risk-off panic kicks in and everyone just dumps everything at once. But when they're buying, the impact is much calmer, more gradual. It really just goes to show you, in the markets, fear travels way, way faster than greed. And the second channel? It's all about tech. There used to be a bit of a lag. Not anymore. Now you've got things like the GIF Nifty, which basically trades around the clock, telling us exactly what to expect when our market opens. You've got Indian companies listed as ADRs in the US. And of course, you've got the high-frequency trading algos that transmit sentiment from New York to Mumbai in literally milliseconds. There is zero lag time now. It's instantaneous.
But listen, this isn't just a one-way story of us getting pushed around. Nope. There's a powerful new force that has completely changed the game right here in India. Let's talk about our new secret weapon, our shock absorber, the domestic investor. This chart right here is absolutely incredible. Just look at these numbers from a year when FIIs were selling like crazy. They pulled out over 2 trillion rupees. But look at our DIIs, our domestic institutional investors. They came in and poured in 6 trillion rupees. That is a massive cushion. That is the domestic force in action, literally preventing a market free fall.
And where's all that domestic firepower coming from? It's coming from you. It's coming from millions of everyday retail investors. This is the power of the SIP culture, that steady, consistent, relentless flow of money hitting the market month in and month out. This is not hot money that's going to flee at the first sign of trouble. This is a structural wall of capital that simply did not exist a decade ago.
Okay, but, and this is probably the most important point of this whole discussion, this is a cushion, not an impenetrable shield. Let me repeat that. It's a cushion, not a shield. Our DIIs are incredible at soaking up the selling pressure and stopping a catastrophic crash, but they can't stop the initial punch. That gut-wrenching gap-down opening you see in the morning after a bad night in the US, yeah, that's still the FIIs. That's still the global money flow calling the shots.
So where does that leave us? How should we think about all this? Well, it means we need to shift our whole mindset, stop trying to predict the market, and start preparing for how it's actually built.
So, let's wrap this up. What are the big takeaways? First, that old dream of a decoupled Indian market, it's over. We are plugged into the global system. Second, the US Fed really does control that global money tap that FIIs drink from. Third, when those FIIs start selling, the impact is way more violent than when they're buying. But, and this is the good news, our own domestic investors are now this huge shock absorber. They can't stop the initial volatility, but they can cushion the fall. So the big lesson? Local volatility often has global roots. The next time our market gets rocky, remember to look west.
So I'll leave you with this to think about. Now that you understand the plumbing, now that you can see the pipes connecting everything, how does that change the way you see all the day-to-day market noise? Maybe instead of just asking, what happened today, the smarter question is, okay, which global tab just got turned on or off?